Your sweldo is about to change. Your pension check is about to change. If you are an OFW sending money home right now from the Middle East, from Hong Kong, from Saudi Arabia, from the United States, the rules governing your SSS contributions, your retirement benefits, and your financial future back in the Philippines are changing in ways that you cannot afford to ignore. And if you are a government employee, a teacher, a nurse at a public hospital, a soldier, a clerk in a barangay hall, the GSIS updates taking effect this year carry real peso and centavo consequences that will show up in your monthly payslip and in your pension account. If you are a senior citizen relying on DSWD's social pension program, or a family member taking care of an aging Lola or Lolo who depends on that monthly support, we have critical updates for you too. And for every working Filipino, private sector, government, self-employed, or OFW, the tax picture in 2026 has its own important story, including proposed changes that could put more money back in your pocket before the year is over. This is the complete, detailed breakdown of every major financial change affecting Filipino workers, retirees, and their families as we enter June 2026. Stay until the end of this video, because even one piece of information here, one date, one amount, one eligibility rule, could mean thousands of pesos of difference for you and your family. Let us begin with the single biggest cash story of 2026 for SSS pensioners, because this is the news that millions of retired Filipinos have been waiting for, and it is happening sooner than originally announced. On April 16, 2026, following a direct directive from President Ferdinand Marcos Jr., and under the guidance of Social Security Commission Chair Secretary Frederick Go, the Social Security system officially announced the early implementation of the 2026 pension increase. This is Tranche 2 of a three-part SSS pension reform program that was put in motion in 2025. Here is what that means in concrete numbers. Retirement pensions and disability pensions will increase by 10%. Death and survivor pensions, the benefits paid to widows, widowers, and dependent children of deceased SSS members, will increase by 5%. This was originally scheduled to take effect in September 2026. But SSS President and CEO Robert Joseph DeClaro announced that the implementation has been moved forward to June 2026, 3 months earlier than planned, in direct response to rising energy costs, inflationary pressures, and the economic disruption caused by ongoing geopolitical tensions in the Middle East. The SSS is expected to release approximately 6.5 billion pesos for this early pension increase from June through August 2026, directly benefiting millions of pensioners and their families across the country. Let that number sink in. 6.5 billion pesos released over just 3 months, going directly into the hands of retired Filipino workers. If your retirement or disability pension is currently 5,000 pesos per month, a 10% increase means you will receive 5,500 pesos starting June 2026. If your pension is 10,000 pesos per month, it goes to 11,000 pesos. If your pension is 3,000 pesos, it becomes 3,300 pesos. The increase compounds on top of Tranche 1, which was implemented in September 2025. For context, a pensioner who was receiving 5,000 pesos before September 2025 received 5,500 pesos after Tranche 1 and will now receive 6,050 pesos after Tranche 2 in June 2026, an overall increase of 1,050 pesos per month from the baseline. And critically, pensioners do not need to file any application or go to any SSS branch to receive this increase. It is automatic. It will simply appear in your bank account or your UMID ATM card disbursement starting June 2026. This pension reform program runs through 2027, when Tranche 3, another 10% increase for retirement and disability, another 5% for survivors, will complete a total pension improvement of up to 33% over 3 years compared to pre-reform levels. For Filipino retirees who have watched inflation erode the purchasing power of their fixed monthly benefits, this multi-year program represents the most meaningful pension reform the SSS has undertaken in years. Now let us talk about what is happening with SSS contributions themselves, because if you are a currently employed worker in the private sector, your payslip deductions in 2026 reflect the final and most important milestone in a multi-year contribution reform roadmap. Under Republic Act No. 999, known as the Social Security Act of 2018, the SSS contribution rate was mandated to gradually increase each year until reaching 15% of a member's monthly salary credit, or MSC. In 2025, a 1% increase from 14% to 15% was mandated through SSS Circular 2024-06, issued on December 19, 2024. That 15% rate is now fully in effect throughout 2026, and it represents the terminal rate, the final destination of this rate escalation journey. There will be no further rate increases mandated after this point. Here is exactly how the 15% total rate is divided between you and your employer. As a private sector employee, you contribute 5% of your MSC from your own salary. Your employer contributes the remaining 10%, plus a small employee's compensation fund contribution. If your monthly salary falls into the 20,000 pesos MSC bracket, the total 15% contribution is 3,000 pesos, of which 1,000 pesos comes from your paycheck and 2,000 pesos is shouldered by your employer. The minimum monthly salary credit is set at 4,000 pesos, making the minimum employee contribution 200 pesos per month, and the maximum MSC is 30,000 pesos, capping the maximum employee monthly contribution at 1,500 pesos. For self-employed Filipinos and voluntary members, people who are not formally employed by a company, including freelancers, online sellers, market vendors, and those who have left employment but wish to continue building SSS credits toward retirement, the situation is different and critically important to understand. Because you have no employer to share the burden, you must pay the full 15% yourself. On the minimum MSC of 4,000 pesos, that means a monthly out-of-pocket contribution of 600 pesos. On the maximum MSC of 30,000 pesos, the full 15% means 4,500 pesos per month. Many self-employed Filipinos underestimate this cost, but failing to contribute means losing months of credit toward your retirement pension, maternity benefit, sickness benefit, and disability coverage. Every month you miss is a month that does not count toward the 120 credited months required for a full retirement pension. There is also an important 2026 update for the Workers' Investment and Savings Program, known as WISP. For members with MSCs above 20,000 pesos, a portion of the employer's SSS contribution automatically flows into the WISP, a tax-free investment account that accumulates dividends and is paid out as a lump sum or addition to the monthly pension at retirement. As contribution rates have risen, the WISP component has grown proportionally, meaning higher-earning SSS members are now building a larger supplemental retirement fund, alongside their regular SSS pension without any additional action required on their part. For the estimated 2.24 million SSS members who may need financial assistance right now, before they ever reach retirement, one of the most significant announcements of April 2026 is the expansion of SSS loan accessibility, backed by a 27 billion pesos allocation. Historically, getting an SSS salary loan or calamity loan required a minimum of 36 months of posted contributions. That threshold has now been slashed in half. As of the April 2026 policy enhancement, members need only 18 months of posted contributions, with at least 6 contributions posted within the last 12 months, to qualify for loan programs. This change alone unlocks access for millions of younger workers and returning OFWs who had not yet built up the 36-month threshold. The policy also now extends loan access to members with minimal past-due loans of up to 3 monthly amortizations, meaning if you missed a few payments on a previous SSS loan, you are no longer automatically locked out of assistance. Additionally, SSS is rolling out a brand new microloan program in 2026, with short-term loans ranging from 1,000 pesos to 20,000 pesos, repayment terms of 15 to 90 days, and an interest rate of only 8% per annum. These microloans are specifically designed to serve as a formal, affordable alternative to the informal 5 to 6 lending schemes that have trapped millions of Filipino workers in debt cycles for generations. The program will be delivered through digital platforms and partner financial institutions, making it accessible without requiring a trip to an SSS branch. For members who want to confirm their eligibility or check their contribution history, the My SSS portal and the SSS mobile app allow you to view your complete records, generate a payment reference number for voluntary contributions, and track your benefit applications in real time. And critically, the SSS now enforces a strict PRN system for all contribution payments. You cannot simply walk into a buyout center with cash and an SSS number anymore. You must generate a PRN first through the My SSS portal or mobile app before making any contribution payment. Failing to do this means your payment may not be properly posted to your account. Now let us move to the Government Service Insurance System, the GSIS, which serves all regular government employees in the Philippines: public school teachers, state university faculty, military personnel, police officers, employees of every national agency, and local government workers. The GSIS contribution structure remains at 9% from the employee and 12% from the government agency, totaling 21% of monthly compensation. Unlike SSS, the GSIS has no ceiling on the monthly compensation used to calculate contributions, meaning a government employee earning 40,000 pesos per month contributes 3,600 pesos from their paycheck, while the government pays 4,800 pesos on their behalf, for a combined monthly contribution of 8,400 pesos. This no-ceiling structure, while resulting in higher nominal deductions for higher-earning government workers compared to their SSS counterparts, also means that GSIS pensions scale proportionally with actual career salaries, often resulting in substantially higher retirement benefits for long-tenured public servants. One of the most meaningful GSIS policy changes of 2026 affects surviving spouses and dependents. Previously, GSIS had rules that suspended or capped survivorship pension benefits if the surviving spouse was cohabiting with a new partner or earning income above a certain threshold. Those restrictive caps on survivorship pension have been officially removed. Under the updated GSIS policy, a widow or widower continues to receive the full 50% survivorship pension regardless of their living arrangements. The benefit stops only in the event of a legal remarriage. This change directly addresses a painful reality faced by thousands of GSIS survivor pensioners who were penalized financially for forming new relationships after a spouse's death. The reform recognizes that financial security should not be contingent on personal living choices, and that a widow who moves in with a new partner to share rent and living expenses should not lose the pension she or he is legally entitled to. The GSIS is also advancing its digital service delivery improvements in 2026 as part of a broader modernization initiative. Government employees can now access more GSIS services online, including loan applications, benefit status tracking, and premium verification, reducing the need to take time off work to visit GSIS offices. The GSIS e-card system continues to expand as the primary delivery vehicle for benefit payouts, with digital enrollment now available through the GSIS website and touchpoints at government agencies nationwide. For job order and contract of service workers, the JO and COS workers who serve in government roles but are not classified as regular employees and thus cannot enroll in GSIS, the SSS has been actively expanding coverage. As of the end of 2025, more than 500,000 JO workers had registered with SSS, with more than 200,000 of them regularly making monthly SSS contributions. This is the result of a sustained push by the SSS in partnership with multiple government agencies to extend Social Security coverage to this large and historically underserved segment of the government workforce. Let us now talk about DSWD, the Department of Social Welfare and Development, and specifically the Social Pension Program, which is a lifeline for hundreds of thousands of the Philippines' most vulnerable senior citizens. The Social Pension Program, or Social Pension, provides a monthly cash stipend to indigent senior citizens, those aged 60 and above, who are frail, sickly, or have no permanent income and no regular pension from SSS, GSIS, or any other source. The monthly amount is 1,000 pesos, which doubled from the original 500 pesos under earlier laws. This 1,000 pesos per month is distributed quarterly, meaning beneficiaries typically receive 3,000 pesos at a time for a quarterly cycle, or 6,000 pesos when accumulated payments for multiple quarters are released together. As of the end of 2025, more than 4 million senior citizens had received social pension payouts. the government allocated 49.8 billion pesos, equivalent to approximately $845.8 million for the social pension program in 2025, with funding commitments continuing into 2026 and beyond as per the Department of Budget and Management. However, there is a painful reality on the other side of these numbers that Filipino families must understand. As of late 2025, more than 1 million indigent senior citizens were on the SOCPEN waitlist. 1 million people who qualify for this benefit, people who are old, poor, sick, and without income, are waiting and not yet receiving it due to reported funding gaps and administrative backlogs. If you have a grandparent, a parent, or an elderly relative who is not yet enrolled in SOCPEN and appears to qualify, the time to act is now. The eligibility criteria are clear. The senior citizen must be a Filipino citizen age 60 or above, must not be receiving a pension from SSS or GSIS or any other government agency, must have no regular source of income or financial support, and must be frail or sickly. Enrollment is processed through the DSWD field offices and the local government units at the barangay level. Bring a valid government ID to verify identity and age. There is also a significant pending legislative development at the House of Representatives that, if enacted into law, would expand the social pension program dramatically. A House committee has already approved a bill that would provide a minimum monthly pension of 1,000 pesos to all senior citizens, not just indigent ones, including those already receiving SSS or GSIS pensions, though with an opt-out provision for those who prefer not to participate. This bill, if it passes the House plenary and then the Senate, would fundamentally transform the senior citizen support landscape in the Philippines by extending the benefit to millions more elderly Filipinos. As of May 2026, the bill has not yet been enacted into law, but it is moving through the legislative process and deserves close monitoring. For senior citizens already enrolled in SOCPEN, one important reminder: DSWD periodically conducts validation and reconfirmation exercises to ensure that beneficiaries are still alive, still indigent, and still eligible. If your elderly relative is a SOCPEN beneficiary, make sure they participate in any reconfirmation activities in your barangay. Failing to validate can result in suspension of payouts. The National Commission of Senior Citizens is also exploring a partnership with SSS to streamline the annual confirmation of pensioners program, which could eventually replace the manual barangay-level validation with a digital system. Now, for the millions of overseas Filipino workers, the OFWs, who are the backbone of the Philippine economy and the heart of millions of Filipino families. In 2025 alone, OFW remittances contributed staggering amounts to the national economy, and the financial rules governing how OFWs connect to Philippine social protection systems have several critical 2026 updates that every Filipina nurse in the United Kingdom, every construction worker in Qatar, every domestic helper in Hong Kong, and every seafarer on the world's oceans needs to understand. First, the tax treatment of OFW income. Under the National Internal Revenue Code and the Migrant Workers and Overseas Filipinos Act of 1995, Republic Act No. 8042, OFWs and overseas contract workers are taxable only on income sourced within the Philippines. Income earned abroad is fully exempt from Philippine income tax. This exemption also covers travel taxes, airport fees, and documentary stamp tax on remittances. This is a cornerstone protection that has never changed and continues in full effect in 2026. If you are working abroad and earning a foreign salary, that money is not subject to Philippine income tax. Period. However, if you also have a rental property in the Philippines generating income, or investments earning dividends from Philippine corporations, those Philippine-sourced earnings are subject to withholding tax. Second, SSS contributions for OFWs. If you are an OFW and you want to continue building your SSS retirement credits while working abroad, and you absolutely should, you are classified as either a sea-based or land-based OFW, and the rules differ between these two categories. Sea-based OFWs Seafarers, cruise ship workers, and others working on vessels are treated similarly to regularly employed members. The manning agency acts as the employer and is legally required to shoulder the employer's share of the 15% total contribution rate. Land-based OFWs, domestic helpers, factory workers, professionals working under individual contracts abroad are classified as voluntary members and are responsible for remitting the full 15% contribution themselves. This is crucial to understand. No one is paying the employer's share for you. If you are a land-based OFW, you must pay both shares. The minimum monthly salary credit for OFW contributors is 8,000 pesos, significantly higher than the 4,000 pesos minimum MSC for local workers. This is by design. The government recognizes that OFWs generally earn higher incomes in foreign currency, and by setting a higher baseline MSC ensures that OFW contributions generate meaningfully larger pension benefits when the OFW eventually returns to the Philippines and retires. At the minimum 8,000 pesos MSC, the full 15% contribution for a land-based OFW is 1,200 pesos per month. At higher declared MSC levels, the contributions and future pension benefits scale upward accordingly. For OFWs who want to pay SSS contributions from abroad, payment options include the SSS mobile app, partnered remittance centers in various countries, and online banking through Philippine banks with international transfer capability. The critical reminder: you must generate a payment reference number through the My SSS portal before making any payment, or your contribution may not be posted correctly, and SSS does not allow retroactive payments. You cannot go back and pay for missed months from previous periods. If you miss a month, that month is gone. On loans, the April 2026 loan expansion applies to OFWs as well. SSS has explicitly simplified eligibility requirements for OFWs under the expanded salary loan program, opening the 27 billion pesos loan fund to Filipino workers abroad who meet the reduced 18-month contribution threshold. Additionally, Double Dragon Corporation has committed 28.8 million pesos to fund a contribution subsidy program for 2,000 OFWs, a private sector initiative that helps lower-income OFWs maintain their SSS contributions even during periods of financial difficulty abroad. And now, the income tax picture for 2026 for every working Filipino in the country. The current income tax framework in the Philippines is governed by the Tax Reform for Acceleration and Inclusion Law, the TRAIN Law, Republic Act No. 1963, which was signed in 2017 and has been fully in effect since January 1, 2023, in its final revised form. The key numbers every Filipino worker must know are these. If your annual taxable income is 250,000 pesos or below, you pay zero income tax. That is the tax-exempt threshold under TRAIN, and it has not changed. For annual incomes above 250,000 pesos, the tax is computed on a graduated progressive bracket system, with rates starting at 15% and topping out at 35% on annual incomes exceeding 8 million pesos. These rates are the same in 2026 as they were in 2023, 2024, and 2025. The TRAIN law has no further phase-in changes. For employees, the 13th month pay and other performance bonuses are tax-exempt up to a combined total of 90,000 pesos per year. If your 13th month pay plus all other bonuses total 90,000 pesos or less, you pay zero tax on any of it. Anything above 90,000 pesos in combined 13th month and bonus income becomes part of your taxable compensation. The de minimis benefits, rice subsidies, uniform allowances, medical assistance, laundry allowances, and similar small perquisites have their own exemption thresholds and are generally not included in taxable income up to the limits prescribed by BIR regulations. For self-employed individuals and professionals whose gross annual sales or receipts do not exceed the VAT threshold of 3,000 pesos, there are two tax options available in 2026. The first is the graduated income tax schedule, the same progressive brackets that apply to employees, applied to net taxable income after allowable deductions. The second is the flat 8% income tax rate, applied on gross sales or receipts minus the 250,000 pesos exemption. The 8% option is attractive for freelancers, consultants, and small business owners with minimal deductible expenses because it eliminates the need to track and substantiate every business expense against taxable income. There is, however, a significant proposed train law amendment moving through the 20th Congress that could alter this picture substantially before the year is over. A House bill, filed in August 2025 and currently in committee deliberations, proposes to increase the personal income tax exemption threshold from the current 250,000 pesos to 400,000 pesos annually. It also proposes to raise the tax-exempt ceiling on 13th month pay and bonuses from 90,000 pesos to 150,000 pesos. The rationale is straightforward. The 250,000 pesos threshold was set in 2017, and years of inflation, including the inflation spike that pushed the bottom 30% of Filipino households to an 8.5% inflation rate in April 2026 against a national headline rate of 7.2%, have significantly eroded the real value of that exemption. A 250,000 pesos annual income exempted from tax in 2017 is worth considerably less in purchasing power in 2026. Raising the threshold to 400,000 pesos would extend meaningful tax relief to middle-income Filipinos who have been pushed into higher effective tax burdens simply by inflation-driven salary adjustments that have not actually improved their real standard of living. This bill has not yet been enacted into law as of May 2026, but with a Senate that has identified tax reform as one of its lead-act priority legislative items for the current session, and with public pressure to address cost of living concerns mounting amid elevated inflation, the bill's prospects for passage before the end of the 20th Congress are being watched closely by payroll managers, HR departments, business owners, and workers across the country. Let us now consolidate all of this into a clear, practical summary. The numbers and dates that matter most for you as you plan your finances through the rest of 2026. If you are a private sector SSS member who is currently employed, your total SSS contribution rate is 15% of your monthly salary credit. You pay 5%, your employer pays 10%. The minimum MSC is 4,000 pesos, and the maximum is 30,000 pesos. This rate does not increase further. It is the final mandated rate under the Social Security Act of 2018. No additional deduction surprises are coming on SSS contributions for the foreseeable future. If you are an SSS pensioner currently receiving retirement or disability benefits, you will receive a 10% increase beginning June 2026, 3 months ahead of the originally scheduled September implementation, due to the SSS's early deployment decision announced April 16, 2026. No application is needed. The increase is automatic. If you receive survivor or death benefits, your increase is 5%, also beginning June 2026. If you are a government employee covered by GSIS, your contribution remains 9% of your monthly compensation, with no ceiling, and your agency contributes 12% on your behalf. The important new rule is that survivorship benefits for widows and widowers are no longer capped or suspended based on cohabitation arrangements, and the suspension of pension applies only upon legal remarriage. If you are a senior citizen who is indigent, no pension, no regular income, no family support, and you are 60 years old or above, you are eligible for DSWD's social pension of 1,000 pesos per month, disbursed quarterly. If you are not yet enrolled, go to your barangay hall and local DSWD office with a valid government ID. If you are already enrolled, make sure you participate in validation activities in your area. If you are an OFW, your income earned abroad is fully exempt from Philippine income tax. For SSS, your minimum MSC is 8,000 pesos. If you are land-based, you pay the full 15% yourself. If you are sea-based, your manning agency pays the employer's share. Generate your PRN before paying. Do not miss months. Retroactive payments are not allowed. The new 18-month loan eligibility threshold applies to you as well under the April 2026 expansion. If you are a currently employed worker paying income tax, the 250,000 pesos annual exemption is still in effect. The train law graduated brackets from 15% to 35% apply above that threshold, and your 13th month pay plus bonuses are tax-free up to 90,000 pesos. Watch for legislative updates on the train amendment bill that could raise those thresholds before the end of 2026. Here is the bigger picture behind all of these numbers, and it matters. The Philippines is dealing with a challenging economic environment in mid-2026. Inflation at 7.2% nationally and 8.5% for the bottom 30% of households, the most vulnerable Filipinos, is placing real pressure on family budgets. Energy costs are elevated. Geopolitical tensions in the Middle East are disrupting global supply chains and affecting the economies of countries where large numbers of OFWs are employed. Against this backdrop, the decisions being made by SSS, GSIS, DSWD, and the Bureau of Internal Revenue have consequences that are not abstract or bureaucratic. They translate directly into whether a retired grandmother in Mindanao can afford her medicine this month, whether a widow in Cebu keeps receiving her pension after living with her daughter's family, whether an OFW in Qatar can get an emergency loan to handle a family crisis back home without resorting to a loan shark, and whether a minimum wage worker in Manila takes home enough to feed her children after all deductions. These are the real stakes behind every percentage point, every peso threshold, every policy change discussed in this video. The government systems, SSS, GSIS, DSWD, the BIR, exist to serve you. But they can only serve you if you know your rights, know your entitlements, and know the deadlines and rules that apply to your specific situation. The single most powerful thing you can do for your financial security as a Filipino worker is to be informed and to act on that information before opportunities close. Check your SSS or GSIS account today. Verify that your contributions are being posted correctly. If you are an OFW, confirm that your MSC is set at a level that will generate a meaningful pension when you return home. If you have an elderly relative who should be on DSWD's social pension program, begin that enrollment process now. And monitor the train law amendment, because if it passes before the end of 2026, Filipino workers across the income spectrum could take home more of what they earn. The Philippines is building a stronger social protection floor for its people. One reform, one tranche, 1 billion pesos at a time. Know where you fit in that framework. Know what you are entitled to, and make sure every peso that belongs to you actually reaches you.